Welcome to Bar Chart's series of webinars designed to enlighten you about a variety of trading ideas and concepts, inform you of features and tools Bar Chart provides related to these concepts, and offer some traders insight to help you make a more informed trading decision. Today's subject, mastering Fibonacci, the hidden order in market movements. Now, long before the 13th century mathematician Fibonacci, Leonardo Fibonacci formulated the Fibonacci sequence, ancient civilizations from the Egyptians through Greeks to the Colosseums of Rome have employed the golden rule or the golden ratio in their architecture and through their art. Now, this seemingly mystical ratio is found throughout the natural world as well. Did you know that a sunflower has 89 curves and 55 of them are arced with the prevailing winds and 34 are against the winds? Now, all three of these numbers are part of the Fibonacci sequence, and their proportion to each other revolves around the golden ratio. Hello, everyone. My name is John Rowland, Bar Chart Senior Market Strategist, and today we're going to discuss the significance of Fibonacci ratios and proportions, Fibonacci price confluence levels, and the application in real-time markets. Now, why Fibonacci? Well, beyond the divine order and the natural world is a religion of mathematics, which disciples of ensuing faith believe in. And this hidden order is also the backbone to many of today's algorithmic trading programs. So do I dare say that Fibonacci proportions discloses order inside of chaos, or probability among randomness? So stick around as we look to the heavens to unravel today's market movements. Now, before we get started, please welcome our moderator and Bar Chart's project director, Jean Baker. Hello, Jean.
Good afternoon, John. It's another Wednesday talking about Fibonacci today.
Fibonacci's. A little weirdness, but I think we'll have some fun today.
Yes. Looking forward to it.
All right, you ready to get started then?
Absolutely.
All right, thanks, Jean. All right, just to remind you that today is for educational purposes only, and decisions to buy, hold, sell, or trade securities is best made on the advice of a qualified financial professional, and under no circumstances shall we be liable for any loss or damage that you or anyone else incurs as a result of any trading or investment activity that you or anyone else engages in based on any information or material you receive through barchart.com and our services. Okay. So Fibonacci. Well, what is it? It's just Fibonacci sequence is a list of numbers where the next number in the sequence is the sum of the previous two numbers. Now, as the numbers become larger, they move closer to a given ratio. Now, this ratio becomes constant the further you go out into that sequence. And that ratio is called the golden ratio, and it is 1.618. Now, its inverse is 0.618. Now, a ratio is just the relationship of one number to another. Proportion is a repeating ratio. And somewhere between ratio and proportion lies a mean. And a geometric mean between a data set is equal to the square root of their product. And the golden ratio has a continuous geometric proportion and mean. And this proportional analysis is that backbone or that bedrock of modern arithmetic programming. Okay. So the Fibonacci sequence is a set of ratios and proportional analysis that reveals a hidden dimension in markets, market impulses, and corrections. And the math behind this is that the structure in our markets, there is a sequence that can be related to both retracements and extensions. Now, when applying a retracement Fibonacci, we're going to concentrate on these ratios. And on our website, they will be expressed as percentages. Now, percentage is just a ratio times 100. So there are some distinctive characteristics which of these ratios we're going to focus on depending on how we decipher uptrends or downtrends. For instance, in strong uptrends, you'll see the market will tend to hold the 382 or the 500. Now, if we were in a downtrend, typically markets will retrace to the 618 or even a greater 78. That's a wrong number. I think it's 786, not 768. So I'm gonna have to check my numbers on that one. And so for extensions, excuse me, it's about strength of trend in time and proportions. There's some kind of symmetry or harmonics through markets. So in strong expanding markets or expanding price movements, then you're going to see a lot of the 127s and the 1618s as reliable targets. However, if we're in a contra trend or a corrective movement, you'll find more 0.618s and 1.0s. So why do they work and how are we going to do this application? So Fibonacci ratios and proportions play a significant role in a market's movements because institutionals and traders alike use these levels to help them determine stop loss zones, targets, manage risk reward, and to help them find potential reversals. In other words, these levels, they use these levels to execute trades, and that is going to create liquidity. Now, price action often follows a natural symmetry where impulses and corrections relate to our Fibonacci's. For instance, a flag and pennants are merely just extensions and retracements ratios inside of a structure. And something like a head and shoulders adheres to Fibonacci proportions when measuring moves from head to neckline. So a head to neckline to right shoulder neckline break is just an ABC extension. And then clusters of Fibonacci ratios with a convergence with, say, classical technical analysis, classical support and resistance, this increases market participants' confidence. In other words, they rely on these values, they believe in these values, and this creates a market behavior. And again, this ideal of order flow. Again, guidance, reliability, and then, excuse me, I have a little frog in my throat, excuse me. I'm sorry, excuse me. There's this reliance and reliability. So we can substitute the word confidence when we're talking about algorithmic executions with the word high probability. Now, this is going to reinforce a positive feedback loop, enhance their predictive powers. Now, in the book of Art of War, Sun Tzu, and I'm kind of paraphrasing here, said, if you understand the tactics of your enemy, you can modify your own tactics and thereby succeed in winning battles. Okay. All right, enough philosophy here. So let's jump into some charts. And so let me do this. Okay. And let me go to here. And what I'm going to do here is I'm going to just shift this a little bit to the left. So again, what we're going to do here is we're going to do a proportional analysis. And what we need to know is where we've been before we know where we're going to go. And so what we're going to do is we're going to analyze this length of trend, this proportional movement, this uptrend. Now, in classical terms, or as we're taught as retail traders, what we want to do is what we're taught to do is we're going to pick out an extreme low. I'm going to go up to my tools here. Oh, by the way, if you're following at home and you don't see your toolkit here, there's a little arrow right here. Just open that up and that'll open your toolkit. And the second one down is going to open up our Fibonacci's. Inside of here, we have a lot of different Fibonacci's. Today, we're just going to talk about retracements and extensions. But the other ones that you might find applicable would be, let's say, the Fibonacci channel or some time zone analysis as well. Okay, so I'm going to go into retracements. And again, classically, we're taught to pick extremes in measuring a movement. In other words, extreme low to an extreme high. Now, again, I'm going to give you a little tip here. You can put on this magnet here, and this is called the snap mode, and this will move the lines right to the closest nearest price. Now, I'm not going to turn this on because I'm going to be overlaying multiple Fibonacci's, and then it gets really kind of messy, and they all start moving around. But I just want to show you that tip. Now, the other thing that before we get started here is I have 3 golden lines here. And so in this demonstration, what I'm doing here is these are kind of areas where I believe that there should be some technical support based on old school technical analysis. In other words, old resistance becomes new support, old resistance becomes new support, or that I'm identifying an area where, the market reversed very quickly on an explosive or impulsive movement. Now, some of you, as we go through this process, are going to accuse me of data fitting, and guilty as charged. But what I'm trying to do is I'm going to show you this relationship to some of this old school technical analysis and the relationship back to Fibonacci. All right. So again, let's talk about, I've drawn this retracement lines here. And again, I'm using my settings here. I'm going to go into my settings for Fibonacci. And you can see we do have other settings in here. But I'm just going to concentrate on the 382, the 5, and the 0.81. Notice here it's in the ratio, but on our chart, it is in percentages. Okay, so I've drawn this line, and now what I've noticed here is I'm looking at this price movement, and you can kind of see that the market is not really aligning with a lot of these Fibonacci levels. So what I want us to start to do is I want us to start thinking like an algorithm, right? Not in the classic what we've been taught, as traders, but as what an algorithm is looking at. And so this extreme low is really just the target of this previous downtrend. So what we want to do is we want to dissect the proportion of the up move, the point where the algorithm switched from a down to an up. So we're going to look for things like secondary swings or explosive candles. And if any of you have followed the, say, Gantt lines or the Gantt teachings, he believed that secondary swings from a bottom had a greater importance. And later that was reinforced by Candace Brown in her work as well. But neither one of these really had to encounter the proliferation of today's program trading, but their accuracy is uncanny. So let me look at this again. So what I'm going to do is say, all right, first of all, well, let's look at this price action. So we have the market falls down. It probably reached a target, a Fibonacci target, and then it had a bit of a correction, right? A corrective wave, and then price went back down again. And so the next day, from this red candle, next day, what did the market do? Well, it gapped up. I know you don't see a void in the chart here, but here's the closing price, here's the opening price. This is called an inside gap. Now, inside gaps are usually filled within that same day, but when you have an inside gap that isn't filled, that is a pretty significant event. So what happens is we have an inside gap, and then this green candle does what? Takes out these previous highs. And this is really the start of this next uptrend based on an algorithmic motion. So if I take this extreme low and move it to this low, and I look at my price action now, well, notice how the market does respect these ratios and how it does this even before we reach our swing top. Proportional relationships at work. Now, we want to do multiple proportional analysis when we're looking at a large piece of data here. So we're going to pick another level. So what did Gann tell us? Well, he said, well, the first swing low from a bottom is a significant level. Well, where's our first swing low? Right here. Now, I could use this value here, or I could use this value here, but to me, they're both the same, because what do we see here? We see a double bottom. So I'm going to come back in here. And again, notice how we get that nice explosive movement. So I'm going to pick that low, and I'm going to go to that high. Again, this is where the snap tool really helps. I'm going to separate these just a little bit, so my numbers might be just off a bit. No worries. All right. And again, now what we're going to do is, as we're starting to do this proportional analysis, we want to start finding where we're getting clusters, or where we're starting to see the lines lay on top of each other. And I'm starting to see two of them right here. All right, let's do one more. So the next one I'm going to do is this one here. And again, this is kind of a swing low, right? Swing low. But again, I'm going to look at this again from the eyes of our algorithm. Now, again, let's think about classical technical analysis, where I've drawn this previous line, old support, new resistance, or in this case, an impulsive move to the upside. So again, I'm going to go in here. I'm going to pick this low off of this big green candle, and I'm going to raise it up to our high. All right, so now what I'm going to do is, well, first of all, which is kind of interesting here, is on this last Fibonacci retracement, I'm going to just kind of move this up and down a little bit so you can recognize this. Notice that our 61.8 retracement, right? Our market reacted to that level even before we reached that apex high. And that also lines with that old school support previous resistance level. So knowing when we start drawing these lines, again, some of you might be accusing me of data fitting, but understanding if you start to see something and they start to recognize the alignment, that you are onto something. Okay, so let's do this. Let's watch up here in the right-hand corner. Let's watch what happens as we move forward in time. Notice how a lot of these levels end up being levels of support, resistance, resistance, then support. And I keep moving farther and farther down the line. And boom, here we are at the current times. So what do we see here? Well, first of all, what we can start doing is we can look at a lot of these levels that have repeat touches or this confluence of evidence, and we can rely on them in terms of our proportional analysis. The other thing we're going to start to look at is where we see that cluster of Fibonacci levels. So for instance, what I see here is that old school reliance of old support, old new resistance, or new resistance, old support, had a significant level. So that's going to be a significant level for us in doing a proportional analysis. But I also see that there is an overlay right here, and there is an overlay down here. So let's do this, because what we're going to do is if I start adding a lot more of these lines and retracements, it's going to get a little messy. So let's do this. Let's make a new line. I right-clicked on an old line. I can just go up here and draw a line. And I'm going to bring that down to this low off of this green candle, which also lines up with our two Fibonacci's over there. And then let's put one inside of these two here. So again, I'm just going to right-click on a line that I've already drawn. I'm going to duplicate that line, and I'm going to put that right in there. And I like these two lines that I just drew. First of all, I really like this one because we have one of our 61/8 and our 50, and the other one that I drew, we had our 50 and looks like a 30, a 32 38 too as well. So I like both of these. Okay, so now I can do is I can come back up here, and I'm going to get rid of these retracements because they're just going to make a lot of noise for us. And so we know that these lines are either levels of confluence or a confluence between a technical analysis and a Fibonacci analysis. Okay, so let's look at this now. Where are we at? Where are we at current price? All right, so let's assume that this is the first leg down of what could be a new downtrend, or what could be a corrective movement. So again, we have to think about this in terms of what our algorithms are looking at, or what the algorithms are doing. Where do we believe that this up movement has changed and that the algorithms are selling? Well, I think we can make an argument this big red candle is really where these the selling algorithms took control. So let's do that. Let's pick that as our top. And this is kind of called what is called truncating or cutting off our tops. Again, thinking more like an algorithm. And let's do a proportional analysis. Well, I want to measure this last move. Now, this last move for me would be all the way down to this green candle. And right there. Okay, so again, let's get a little bit better there. All right. So again, what do we see here? We do see that even before we made that significant low, we do see a cluster of evidence right around that 50% retracement and also that 61/8 level. And again, I know some of you are going to say, oh, you're not exactly 100% or, holding data lines. But look, I mean, this is this is the mystique of Fibonacci's. So now let's do this. Let's make the assumption that there's symmetry in our markets, or this harmonic symmetry. So we have this leg down, and now the market came up and it made a corrective move, and now we're having another leg down. So let's do this. I'm going to kind of draw a box here just to kind of help you out a little bit visually. So here is that movement. And what I'm going to do now is I'm going to take that movement from this high, that corrective high, and I'm going to just overlay it on my chart. Now, what is fascinating here is that a 100% movement, in other words, if I have symmetry in this market, notice how it lines up with one of those lines, that cluster that we already created. So that is very significant to us. And again, if I break this down in terms of our Fibonacci's, again, remember these lines above, we've already done that. So what I can do here is I can just grab this one and slide it down. And again, there's that 100%. What we notice here is there is some relevance to our market here in terms of our most recent wave down in our proportional analysis. Well, let's do a next level. And so the next level is what we said was, hey, this value here seems to be a very significant level for us. In other words, there's significance when we touch it and stay above it, and there's significance when we touch it and fall below it. So again, we could do a proportional analysis based on this this high and this low. Excuse me, this transition spot. So what I'm going to do here is, again, I'm going to take my Fibonacci here, and let's get that out of the way. I'm going to do a proportional analysis like this, and then I'm going to drop it below, and you can kind of see how this is starting to line up again in that proportional analysis. Now let's take it one step further. Let's look at this from a extension. So here we are, we have our trend Fibonacci-based extension. And again, I'm going to think about this in terms of our algorithmic movement. So down to our green candle, back up to our corrective candle, and then we set those extensions. Now, remember what I said to you. In corrective movements or in counter trend movements, typically you'll see a very reliable target is that 618. And notice that in this movement, that's exactly what the first target was. The second target would be the 100%, and that would be down here. So let's do this. What I have now is I'm getting a lot of lines starting to form a confluence right in here. So this has now become a very significant level of support for us. So how can I use this? Well, I could say, well, if I'm looking for a buying opportunity, maybe I wait patiently until we test this level, or maybe I thought that this was a good buying opportunity, buy the dip. Well, I could use this as a backstop. In other words, I can use this to my risk assessment. If I'm taking a short, I need to realize that whatever short that I'm going to take, I know that this now becomes a very significant level for me. So that would be my risk to the upside. And then if I'm going to take a short anywhere in here, I also have to realize that this is going to be a risk because this is going to be a major level of support. So whatever risk I take, I want to make sure that that risk is much less than the potential target. So right now we're kind of right in the middle of that range, right? So probably not a great trade from the short side. Certainly from the longer side, there is a lot of positive information here. It says, hey, I could take a long right here, risk this most recent low, this Fibonacci level, and as long as the market stays above that, then they're probably going to see a corrective, or excuse me, a re-engagement of our longer term trend. And then I could do some Fibonacci extensions to the upside. Yeah, just kind of, I want to kind of answer questions as we go along before we move into different analysis. So there's a couple questions here about time frame that you work in. So we can work in all time frames, right? I'm going to work a lot of dailies. I think any Fibonacci analysis or proportion that you're going to use, you need to use at least dailies as one of them. But we're going to looking at what is called the fractal fractalization. In other words, moving from a higher time frame to a lower time frame. So I see a couple questions based on that. So stay with me on that one. I think Howard just asked about stop loss and targets on S based on, again, it's going to be based on the individual trader. You can either wait for the market to reach this potential target, or let's say you do a confirmational entry, let's say a long, Howard, where we wait for us to recapture the 618 on our way back to that significant inflection point, and we use this as a backstop, or in other words, a potential stop loss level. Okay. All right, let's see here. Let's do this. All right, I'm going to go to the cues here. And again, let's kind of slide this over here for a second. All right, so there's another proportional analysis that we can use, and that is when we look at gaps. And we can find proportional movements with a gap. Now, what we're going to do is we're going to position the gap at a 50% inside of the range that we're going to dissect. Now, and those of you who follow me, and those of you who have been in a lot of my webinars, you know that I've done many webinars on gap analysis or gap theory. And to me, gaps represent a major landmark. There's something very significant about it. So this is just another application of doing gap analysis. Now, let me just give you some caveats here. First of all, if you're trading an equity that has a light volume, doesn't have a lot of volume, you're going to see a lot of gaps, right? Or if you're trading an ETF, maybe not one of the majors like we're doing here to, maybe like a sector ETF, you're going to see a lot of gaps. What I'm talking about is an outside gap. In other words, where the gap is above or below the previous day's close. And typically those gaps are 2% or greater, all right? So again, what are we going to try to do? We're going to try to do a proportional analysis based on the fact that this gap is 50% between our legs or our impulse, or how you would determine a trend. So let's do this. So down here in my toolbox here, I open this up and there is a 50% line tool, and here it is. And so we know that we're going to take this high. So I'm going to take that high there. And I'm just going to move this out of the way for a second here. And we want to try to find, a value that's, 50% or below here. But remember what Gann told us? A secondary swing low has greater importance in proportional analysis, right? Second swing low right there. And again, I know some of you are going to think I'm data fitting here, but watch this. I'm going to apply it, and boom, right in the middle of our gap. Now, let me see if I can kind of tighten this up. Okay. All right. So this gap now has some major significance. Now, don't be worried if your 50% line is not exactly 50% into the gap. I like the kind of how this line is lining up above this little green wick, this green candle, and then below this little red candle here. So I like that. So what we're going to do now is we're going to proportionalize this. We're going to go to our retracements, and we're going to retrace the up section, and we're going to retrace the down section. Okay. All right, so what do we see? Well, we do see that the market does respect many of these values as we rise up. And then as we fall down, we can see that, again, how they are reflective in our price movement. Okay. Only old school resistance, new support, new resistance. All right. And then eventually, again, these yellow lines here represent where I thought that there might be some potential for the market to hold or values. And so, yeah, again, we can see that how these are playing out in our technical analysis. All right, so let's do the same thing that we did before, where we do a proportional analysis based on what we see in terms of our market here. So let's measure a move. Okay, here's our algorithmic high. There is our low. And again, starting to see some clusters here in terms of significance. And again, what I can do here is, again, yeah, I'm going to draw this box here just so you can help you with your visualize this. Again, I can do a proportional analysis, a symmetry move, and that our 100% falls into, I've already designed the box here based on, again, look at our 50% retracement of our gap analysis. And if we did some more proportional analysis, you will see there will be a lot of clusters in there as well. All right. And then I can also do my Fibonacci extension. And again, similar to what we saw with our S&P, in corrective movements will bounce off of the 618 level. But if we have a failure or the market continues in that direction, the next target would be the 100% extension. So again, this cluster of evidence that this is a very major level of support. So I think Howard was like asking, well, how can I manage my risk? Well, on this particular day, when we reached the 61.8, Howard, you could have used this as your potential risk to the downside based on what you think would be the next leg up. And again, we'd have to do a proportional analysis based on, that bigger time frame, and we probably would get some value up here as a potential target. Now, so that brings us to this point, and this is what a lot of you are asking me is about, can I use multiple time frame analysis to help me with determining if this is a good entry level based on my thought or my belief that this is a corrective move. And now that we have this confluence of Fibonacci evidence. So I could take this trade and then set a target based on these overlapping levels, and that would be probably a good trade in terms of a risk reward. But what I'm going to do here is I'm going to go into my templates here, and under my templates, there's a bar chart template. You got to scroll it down a little bit. It's right here. It says 13 EMA pivots. And what this gives you is you're going to look at the market at a 30-minute time frame. You're going to get a 13 exponential moving average, 13 30-minute periods. 13, by the way, is a Fibonacci number. And you're going to get what is called the floor traders pivots. And the floor traders pivots are values that are based on the previous day's trading range. And then what it does is it extrapolates where you could find levels of support and resistance based on yesterday's price action for the next day. Now we're looking at today's pivots. And so I just want to kind of show you what we're looking at. Let me get rid of this box here. And I know this is kind of messy here. So let me get rid of the RSI as well. Is the blue here, the dark blue, the light blue, and the super dark blue here represent the pivot supports. And on the upside, you have the red lines represent pivot resistance. So this is today's pivots action. So what I want to look at is I want to go back in time. Now, unfortunately, I can't do that on our website because we're always moving forward with our pivots. But what I did was yesterday when I was setting up for this session, I took a screenshot of as the market was reaching our 61.8 corrective target, and notice that our pivot support, number one support, is right on that line. And then here is that cluster where we saw all those other Fibonacci levels. So imagine this. I'm taking a trade based on a higher time frame where I'm originally, Howard, I thought I might have to risk as much as 10 or 11, or in this case, looks like 17 points. But what I can do is use the intraday pivots to help me manage my risk. In other words, I could wait for the price to come to my Fibonacci level and then wait for it to recapture the support on its way back to either the moving average or the intraday pivot or a potential target. This could be for a day trader or a swing trader. But look at how much I've reduced my risk, even if I used, let's say, the first to the second level of support. So wait for a confirmational entry. Now let's go and look at this in terms of what is going on today. Again, there is where we talked about that opportunity to take a buy. And where did we see that potential up move? Well, that up move, we can see we would have got a nice little risk reward here. We're only risk 2 points. We could have done that, would have been a nice day trade. But in this case now, we've gotten into this long trade for a longer period of time. And now what I'm good to say is, well, look at my targets for, let's say, a swing trader, or maybe even a longer term trader. I could look for some other levels. Now, again, we're in the 30-minute time frame, so why don't we just do a Fibonacci retracement? And whoops, wrong one. And look at that, how our daily pivots at this intraday time frame have relevance to our day traders pivots. Again, let me just move this around so you can see those values. There they are, right? Yesterday's price movement, today's pivots. Okay, so I hope you appreciate that one. That is a really good technique to use in terms of when you get to day of action, when you come to one of these levels of confluence where you want to make that decision of, I want to take on a trade or how. And again, this is really how algorithms kind of dissect the market. All right. All right, so let me answer a couple questions here, and we'll move on to the next segment. I'm getting closer to my time limit here. Yeah, a lot of reaction here, a lot of thanks. Okay, guys, great. Okay. And I see Gene is answering a lot of these questions. Thanks, Gene. Appreciate that. Okay. All right. So let's move on. Let's move on to one more example. Maybe we'll get two more examples here. All right. So let's go to Amazon, and we're going to move away from our pivots, and let's just go to a just chart here. And what I want to do here is I want to do this fractal analysis, big picture to little picture. But I also want to address a question that hasn't come up, but I'm sure there's folks out there who are probably thinking of this, or those who might watch later. The question is, what type of chart would I use? Will I use a linear chart or a logarithmic chart? Now, typically when I'm doing, looking at price over a longer period of time or a greater data set, that I'm going to use a logarithmic chart. But Fibonacci's and Fibonacci proportions are logarithmic in nature. And I want to do a lot of that symmetry, right? That harmonic analysis. So I will change when I do Fibonacci's to a linear. Now, I've heard the debate on both sides, and they both make sense to me. It's just my own personal preference. I want to have a more linear chart, especially when I do that proportional analysis. Okay. All right, so let's look at Amazon from a big picture. Again, I'm in a monthly chart here, all right? So what's our old school? How are we taught how to draw, retracements? Well, we're taught from extreme lows to extreme highs. Now, again, if I do this analysis, what do we see? We don't see how our fibs are really falling on any of our levels. They're not offering us levels of support or resistance. Remember, proportion works as we're getting to our apex. Well, let's think about this in terms of an algorithm, right? Again, what do we see? Well, the market has come down, it's found a target, it's kind of bouncing back and forth, probably a little battle between the buy augs and the sell augs. But where do we see that change? Well, that change, right? 1, 2, 3, 4 tops right there. And here's that big explosive candle. So let's move this low to this explosive candle. And what happens? Now we see our price action is more in line with our Fibonacci's. So let's do another extension. We want to do a couple of these. All right, well, here's another one. Here's another big breakout, big one. And I'm doing that proportional analysis. This is very close, right? I could probably do a little bit better job drawing to our previous ratio. Again, now notice how as we move farther up in price action, how our lines are starting to line up, right? So we know we are in the right neighborhood. We are doing the right job. So again, let's go and let's say from from here or from here. Let's do another leg. So here's a little tip for you. When you are starting to look for support levels or you're looking for resistance levels, make sure that these retracement levels that you're going to do fall below current price. Now, if I do a analysis, let's say this low here, well, notice how now my retracements are above my current price. But I do want to just point out that this last monthly candle is bouncing in and out of that. So what we need to do is we need to find a lower. Well, Gantt tells us we could use, a secondary swing low. Now, again, we're probably closer to, the same data that we looked at from that green candle, but let's go back to this low here. Right? And so what do we see? We see a nice cluster right there, but we do see a small cluster right here. Now, again, I could go, let's say, whoops, from this explosive candle, this breakout candle. Notice again, another cluster right at this monthly low. Again, there are a lot of secondary lows here that I could use that would give me those values. All right, so we have this cluster right here, right? Old school, right? Old resistance, new support, Fibonacci cluster here. Remember, we're at a monthly time frame. So let's jump right down to our EMA. And there is those two monthly Fibonacci levels. And again, I'm looking at today's pivots, but if we went back in time, we would have seen a lot of the pivots would have been lining up against here. Notice on our RSI, this is using another technical analysis. We were oversold in this time frame, in this 30-minute time frame. So again, what we could do is we could wait for price to come into this zone, use our daily pivots to help us manage our risk. Notice how we got a lot of confluence down here, right? So that could be managing our risk and then take that particular trade based on, again, a higher time frame analysis. I've come to a level of confluence, and now I'm using a lower time frame analysis to help me manage my risk. Okay. All right. All right, let me take a moment here and read some more of these questions, Gene. So there's a question about looking at lifetime high prices. So, it's tough for me to do an analysis on lifetime high prices because literally we just recently made all-time highs. But I kind of showed you that, how you can use that. Think about, again, looking at a proportional or a wave, looking for that secondary movement from the top down, or that truncating, where that accelerated movement could be found. Okay. All right, let's do this. All right. I think I answered most of your folks' questions, at least the ones I am looking at. Okay. Yeah, I'll just double check one more time. All right, great. All right, so what are some takeaways here? So the first takeaway is Fibonacci can be applied at any time frame, but it has a greater accuracy and probability at higher time frames. And I kind of showed you that, right? We did a lot of work in the dailies. We did a lot of work. We did that work in the monthlies. But I can apply Fibonacci's at a lower time frame to help me to manage my risk. We're going to concentrate on those areas where Fibonacci lines cluster together, right? This is going to create a confluence with, let's say, our classical technical analysis, old support, new resistance, old support. But in our previous webinar, which I'm going to show you in a second on our archive page, where I did Fibonacci analysis, in that one, I used a lot more classical technical analysis, things like RSIs, MACDs, and Bollinger Bands to find that confluence between our Fibonacci lines and more of a standard or classical technical analysis. And understanding that these Fibonacci levels, this mystique about them, are predictive frameworks for price action that aligns with both discretionary trading, which we're going to be doing, and this algorithmic trading behavior, this kind of this self-fulfilling prophecy, but also this positive feedback loop. Again, where are they going to execute their trades? And finally, you know, traders who understand these relationships can anticipate these market movements more effectively. In other words, setting precise entries and exit points. And I kind of showed you how to do that by using that multiple time frame. But now what you're doing is you're trading more like an algorithm, more like an institutional trader. And this comes back to that religion of mathematics, faith in the mathematics. Fibonacci's are not just linear, right? They are found backwards and forwards. There is a spatialness to them, and that their predictive powers come before apexes and troughs. Okay, I hope you guys enjoyed that one. I know it was a little fast and furious in terms of analysis, but again, remember, look at the market not from the classical peak highs and peak lows. Think of it in terms of proportionalizing those moves that you see, and that looking for that symmetry, looking for those gaps, looking for the relationships of price action. And again, trust if you are drawing these lines and they're falling on highs and lows that you are in the right neighborhood. Okay, so I hope you guys enjoyed it. So let's do this real quickly. Again, if I go to my archive webinars, you can see that today's is up here. And if you go on this page, you can find the slides from today, but also down here is that Fibonacci where we look at more of that blending of confluence of Fibonacci lines with classical technical analysis, relative strength indexes, Fibonacci, MACDs, and Bollinger Bands. Okay. All right. Next week, let's see what we got for next week. Oh yeah, I forget. Next week we're gonna look at spread trading. I get a lot of requests for this one. I've done a few of these in the past, but I'm gonna update what we look at, and we're gonna talk about spread futures trading. And one of the nice things about spread futures trading is that you kind of get a benefit of two worlds. First of all, your margins are a lot lower, so your capital expenditures, or the capital you have to put these trades on, is a lot less than trading outright futures markets. But it also, you can mitigate a lot of your risk in terms of directional movement as well. But because you're using less margin on individual trades, you actually can leverage with margin as well, which is really a fascinating discussion. But we're going to look at things like contango, backwardation. We're going to look at intermarket spreads and intermarket spreads. We're going to look at how to look at seasonal trends in terms of your some of your commodities to look for trading opportunities using spreads. So if you're a futures trader or a spread trader or something that you want to look something a little bit new, I would say come on and check that out. I think you guys will enjoy that. All right. Until next time, folks, best of health, manage your risk, and the good of all trading.